Welcome to TradeTheMBI.com. This is John. This reports for the 11th, and finally getting out of the fog of unwellness. And, so is the market here. Not that the market has suffered at all, because this has just been, going all the way back, to the beginning of summer, really, and even before, from last year. We knew this market was going to be on a tear because we were changing a major transition from no growth policies to an active growth policy, and you can see the effect of that. And even with the tax reform and everything else, while those are supplementals to it, you can't alter the general course of things. I mean, you can try and buck a trend, but as long as there's this intention towards an active growing economy, I think the bias for many traders has to be to the upside on things, and that certainly puts us. Now, are we too far? Well, that's a different issue. This particular point, not reading that yet. We're seeing a lot more overbought here from a daily standpoint, so that is a little bit more concerning in the sense that you're not likely to get huge breakouts, but more likely to just consolidate going across until we can ease some of this. The reality is, though, shorts have been out of this for some time. Short-term buyers, that was the new fund money that came in around the 5th of the month, and it was enough to pull things out of the doldrum, even though if you could really call that minor. I mean, we had a major spike up on news, and then it retraced it, and now we're just filling it back in. So nothing too dramatic in that sense, other than just solid readings from Shakeout being well over the positive line here. It's only when you get into this negative territory do we have a real chance of any breakdown, and that's when we tested the green ABM at this particular point, but then ended up with the nice reset. And it was a little suspect too, because I mean, usually what you want to see is the steel come from the lower part, crossover on a reset of the midterm buyer's green, and then everything cross over together at the same time. What you ended up having was the steel crossing above cyan, which is usually bullish as well. So it was a secondary bullish screen right there, along at the same time. Then you were getting the midterm buyers crossing above. At the same time, you had the orange drop, and so that led to this most recent rally, and that was back in November. So this is where we have it right now, and you can see we've had a fade off of the red DOC, and all that has been easing off, but at the same time, so have cyan shorts. So kind of tracing together lower, which means that as long as there are new buyers, you're not looking at any major resistance. And I think from a holiday standpoint, the lighter volume, it allows for a little bit more gyration, but it also indicates that there's no real huge threat. We are looking at these potential red break lines, and that's just because we are at that point of what you would consider as a DOC spread, but very weak one in the sense that you have cyan shorts fading off dramatically, and you already have a reset on the NASDAQ of the long-term buyers. So it's happening way down here as opposed to the zero level where you would expect it to take place, that you might see it. But it is a warning, and it just says to be a little bit more cautious. And you can see the weakness of the NASDAQ in relation to the S&P. And that is a byproduct of the fact that the NASDAQ had gotten so far ahead of the S&P. But there's some little difficulties with that. We've also had a trail off of the euro. Now that the bird exit looks like it's moving forward, and a lot of the arrangements have been made. There's no longer a need to float it out of fear, so it's sort of easing off a little bit. It looks like that transition's going to go just fine. The people who are active still running up bonds in this particular case. It's interesting, though. We have to imagine that even with the transition in the Fed, whether or not the rates will go up here before the year end, it's going to be an interesting one. I would think that there should be, but if there's a postponement, it'll be definitely something that will be a shock, because it would indicate that there's further weakness when we're really not seeing it with these massive manufacturing numbers, unemployment, labor participation. Those things are all moving in the right direction. The question will be, will the Fed pounce on it as quickly as possible to thwart it? So that'll be an interesting one to watch. I would suspect they should do it, but if they don't, I think the market could rally significantly. Oil is maintaining this elevated area, a brief dip here below the green line. No real reset to justify the bounce back yet at this particular point. We've had obviously short-term buyers have been reset all along on it, but doesn't look to break out of any range or anything at this particular point. And like I've been talking about, the inverse relationship between the move in Bitcoin and that, cryptocurrencies versus gold, it's really been a great trash, but you're just still not seeing the inflationary pressures. And this goes back to what I was talking about, the massive amount of labor that's still available to be tapped before wages are going to start driving things. We're going to start keeping a closer eye on it going into the beginning of the year, particularly with some of the numbers that we've seen increase as far as manufacturing and that. So this will certainly be one to watch, because I think that we're going to reach a level where it could become very attractive for a longer term play. And you can see the range increased dramatically on Friday, but there really wasn't a whole lot to do trade-wise. I mean, we had the cyan under red, and then we ended up with some elevated areas, but it's just a question. If you're playing a long term, I was just playing the 50% retrace level as a stop as it continues to rise. So it really didn't affect me at all, given even the short signals. If you're playing a little bit tighter, you would still expect that 71%, actually 76%, I believe. Let's try to get our line, 76.4 to be precise on there, is an excellent one. It's also usually below the ABM green, but not in this particular case. The ABM green was trailing slightly lower, and then they caught up to each other once we got towards the later part of the day. So it depends on how early a run is, depends on whether or not I'll follow the higher Fibonacci or just the ABM green. Usually I like to leave a little bit of room. That's why I was staying with 50% as a safe, under the radar. And it moves a lot slower unless you're making new highs, and then it will begin to increase significantly. And you got cheese from all the way back here. We were down at the 33 level, and so now it's at 45, even though price is 8 or 9 points above that still. So yes, it's lagging, but it'll start to accelerate pretty quick, particularly if you get a flat area where there's no new highs being made. All in all, though, I think that we've been seeing everything pretty much go this year as we thought it would. There were a lot of naysayers and a lot of doubters. There still are, and a lot of people think that these numbers are crazy. I was saying that we should be floating somewhere around in this 2660 range to 2640. If we break out past here, are we really looking at 27? It just seems a little bit of a stretch. It's not impossible. Maybe something special happens, but I think that we'll probably have to consolidate just a little bit longer before we see any activity that really pushes us to new levels. But stranger things have happened when there's excitement and people are feeling euphoric, and we have low volume setups going into the next couple of weeks. It's going to allow for a little bit more of a gyration before we begin the new year. So we'll just play the signals as we get them. And at this particular point, we got a couple of warning signs from the daily that we just need to be, attentive from a NASDAQ standpoint, less so from S&P. But I can change pretty quick with what we're seeing on this DOC. As long as I shake out those rising, I think any pullbacks are just temporary, and no need to get worked up over it. So that's the long and the short of it, mostly long. We haven't really talked about short because it just hasn't been any real justifications for a short, which is also important. We need to have a justification. It can't always just be a technical reason. Typically, a lot of times these shorts will show up when they just suggest that there's going to be a softening, and that's the way we've always described it, as opposed to full correction. And those become very different things based on overall macro climate. So that's a lot of winded nothingness. So anyway, trade well, and we will talk on the Skype chat.